This is On the Money with financial advisor Ryan Wheelis. And, I do want to say this for listeners, viewers out there. We laugh sometimes because you just have to when times are going up and down and up and down. We are definitely not laughing at what looks to be smaller account values, a 5 or 10% drop in the markets. I think what we're trying to do is just say, hey, we have seen this before. This is not the first time this movie has been played. Now, is it with a new gunslinger or a secondary, a comeback gunslinger in the White House? Yeah. So is some of this on purpose? Perhaps. I think so. But how are we reacting to it? Are people comfortable with this risk? Forget me and you philosophizing about it. How about somebody who's come in recently and says, yeah, I'm a risk taker. I'm okay with this. And when you showed them exactly what's happening, did they still stick by the way that they're investing?
Spike, I've got two scenarios here that are interesting. One of them is a guy has been with us for a couple of years, and he's constantly aggressive. He wants to be in our most aggressive stuff, and we've got aggressive stuff. And his risk tolerance and certainly the guidelines meets his ability to invest in risky stuff. And then he's got like a do-it-yourself stock portfolio outside of us, and he, trades his stock portfolio. And it's interesting because he compares what he's doing to what we're doing with returns. And he comes in recently, and after the market had pulled back substantially, he's lost substantial money in his personal do-it-yourself account. We're down some in his account with us because again, he's aggressive. Okay, and he's ready to start income, and between his Social Security check and his distribution from his retirement account, he needs $7,000 a month to maintain his lifestyle after tax. And so he's like, well, Ryan, I don't understand something. You haven't made me enough money this month to pay me my $7,000, which is not total money he needs, but that's what he was saying. And of course, I had to remind him, hey, you don't need $7,000 because you have Social Security coming in. It's less than that, but different conversation. But he was adamant that we didn't make enough money this month. And I was like, look, man, you got to understand something. There is no financial advisor, no investment company, no money manager, no mutual fund manager, no ETF. There is nobody out there who's going to make you money every single month. It just doesn't work. And if they tell you that they're going to, or they are, you might think twice about working with them because something doesn't smell right. All right. And, the thing is, you have to understand something here. When you retire, you have not reached the finish line. You got to live the next 10, 20, 30, maybe even 40 years in retirement and use your nest egg to finance you living the next 40 years, 30 years, 20 years, 10 years in retirement. And if you're going to rely on the stock market, because that's what you've done prior to retiring, that's how you've always invested, and you want to rely on the stock market into your golden years where you need your nest egg to make a paycheck to maintain your lifestyle, when the market goes down, you're going to be selling things at a loss to generate income. That's the way it works. Early on, I tried to get this gentleman to put 3 years of income in a cash bucket and find the highest savings account, yield account, whatever we could do, cash management account, whatever, so that if the market downturn came, he would not have to sell securities at a loss to get his $7,000 a month of paycheck. But he was adamant that he wanted all of his money invested in the markets at all times. As much as we try to help, some people have to learn. They just have to learn and experience. And what's really interesting, Spike, is when you leave that job and you walk away from that paycheck, the emotional ties to your money, especially when it's going down in value and you need to take your paycheck out of your account that month to finance your lifestyle, the emotional ties to that and concerns and scarcity and just feeling of out of control, it's terrifying.
Yeah.
And that's where it comes from. And so I'm hopeful I can get this gentleman to come around. I mean, I'm working on him, working hard on him. But the reality is,
can I ask you a couple of things? Yeah. It's just, so how old is he? Without giving him
62.
And is he still working, or was he able to?
No, he's done. He retired.
Okay. All right. Is he married?
He is. His wife is 10 years younger than him. And again, against my advice, he filed for Social Security at 62, which means when he dies, whatever the amount of the Social Security check he has coming in, his wife will get that check. She could have gotten way more. And I guess, Mike, that's just, the thing is like, I'm like, I even asked him, I was like, why are you even working with a financial advisor if you're not going to listen to the things that we have so much experience with doing. It just doesn't make any sense. And I'm trying really hard with this gentleman.
So let's flip it. Let's say that he saw the light. 62, maybe you can give me an idea of how much he saved. What would you do to reverse to make this situation as perfect as you could?
We'd have built a house. It's the best way I could explain it to folks driving down the road, listening to the radio. I would have built a house for them. The first thing would have been a foundation. And a foundation is unshakable. Tornado blows through a neighborhood. F5 tornado goes through there. What do you see on the ground? Foundations. They're still there.
You'll still see the basement.
That's exactly right. So I don't think the 20% pullback we've had in the tariff tantrum here is what this is going to be called, by the way. The tariff tantrum is an F5 tornado, by the way. Okay, it's not even close. So, but the bottom line is we would start with a foundation. Now, what is a foundation? The foundation would be a blend of some type of program that provides a reasonably amount of stable guaranteed income in some cases. That could be some type of an income annuity, an index annuity with an income rider. Fans of those or an immediate annuity of some kind. I'm fans of those for adding to your Social Security so that between the Social Security and the annuity, you've got a certain amount that comes in for the rest of your life. Doesn't matter what happens with the stock market. Doesn't matter what happens with the economy. Doesn't matter who's in office. That money comes to you regardless. Okay? Then to supplement that income, we start looking at things like private credit funds. Now, private credit funds are very interesting. Yields in those things are anywhere from 8 to 12%. We have one particular private credit fund where the share price for the last 6-ish years was issued at $25. It's been as low as $25.30 and as high as about $25.90. Excuse me. It's been as low as $24.30 and as high as $25.90. So in a 6-year period, that share price started at 25. It went down to $24.30, went back up to $25.90, and it's kind of ebbed and flowed between those, all while paying between an 8 and 10% yield. So I would add some of that in. The next thing I would do is add in some structured notes. Structured notes pay 10, 12% income, and they have downside protection. So you would have an income bucket here that's producing a large amount of income just in a very solid way. All right. Some without risk at all, some with a low level of risk, and some with slightly elevated risk than low level, but still pretty low risk. The next thing we would do is look at, all right, we've got to battle inflation. We want to leave a legacy. We want to, invest now to have vacation to the future. There's things we want to do out there in 5 and 10 and 12 and 15 and 20 years out in retirement. So we're going to take the walls of the house, build up the studs, if you will, in the frame and put the walls up. That would likely be a tactical portfolio that is specifically designed to mitigate downside risk first and maximize returns second. Mitigate downside risk first and maximize returns second. Next, we'd put on a little bit of risk, a little bit more risk, if you will, and this would be the roof, the shingles, so to speak. The shingles would be a stock portfolio, growth stock portfolio. I'd split that over probably 2 managers. So if you had, $200,000, we'd allocate to those growth stock portfolios. I'd probably put $100,000 with one manager and $100,000 with another manager because those managers do different things and have different perspectives and see things differently. So in that, you would have a complete portfolio with one more addition. We have to have one more thing outside, okay? And that is a bucket of cash. Bucket, $7,500, $1,000, $200,000, whatever your net worth is, cash bucket should be appropriate to that. We'd have that cash bucket. That type of planning, Spike, is the way to go. It allows people to have a level of confidence to be able to go out into the world and spend money with confidence, regardless of what happens with the stock market, the economy, interest rates, who's in office. It's a much better way to plan.
Folks, call the phone number right now. Let us do your complete portfolio risk review done by our certified team of financial planners. We will literally put together your written financial plan, put together your entire house of financial retirement for you at no cost to you. 2 very simple tools right now. Call the phone number or text us. It's so simple. 844-944-7555. There are people standing by right now who will schedule that appointment for you. Or very simply, you text us. Type in 21000 into the number portion of the text. Write in the word plan, hit send. We'll get in touch with you and schedule that appointment for you. You're listening to On the Money with your financial advisor, Ryan Wheelis. Oh my gosh, market volatility. Theme of today's show. More of it when we get back right after this.